Okay, thanks very much. So good morning, everyone. Welcome to the 1045 session. My name is Ian Mack. I'm a partner with McCarthy Tetra. We're a full-service law firm with offices across Canada and also New York and London. I'll be your moderator for this panel. And the topic for this morning, lending to lenders. Strategies and insights for alternative lenders to consider when raising capital to fund their book. And we've assembled a very excellent and knowledgeable panel from the industry with tremendous knowledge, so I think it'll be a very insightful discussion. So some very quick introductions of our panelists. Starting on my right, Lila Kanji, Head of Specialty Finance with BMO Financial Group. Next we have Kevin Westfall, Vice President, Accord Financial. We have Wayne Pauman, President and CEO of PayBright. And last but not least, we have Tyler Myrick, Vice President, Corporate Strategy for Purpose Financial. So I'm going to throw it over to our panelists to give a brief overview discussion about their organization and how they're involved with specialty finance. So we'll start with Lila.
Thank you, Ian. So one of the key strategies that's been driving growth for our commercial banking platform over the last few years has been industry specializations. So as part of that initiative, we rolled out a specialty finance dedicated team early on in the year to focus on this important and growing segment. And while the launch has been this year, as an institution, BMO has been lending and has been active in this space for over 10 years. Through our BMO Harris platform. So we were actually very fortunate to leverage their skill set and their knowledge base when we rolled it out here in Canada. But we do recognize that Canada and US are two different markets, especially in terms of scale of the borrowers and maturity of the segment. So as we are rolling out our vertical here, we are taking into account those nuances. So we're now ready in the market, actively speaking to borrowers and doing transactions.
We were established in 1978 and listed on the TSX, originally as asset-based lenders. So kind of just providing our own capital to mid-market companies. And really about 15 years ago, started to grow in the lender space. So kind of understanding from ourselves as lenders, how do we kind of accommodate and lend to other financial institutions. We've worked with merchant cash advance businesses, those in the kind of small loan space, subprime auto loans, personal loans. So we've got about 15, 20 years of experience kind of lending to other lenders.
So PayBright is a so-called buy now, pay later company. We run the point of sale financing model, which means we partner with merchants and retailers of various kinds and allow them to offer installment payments to their consumers at the point of sale. We work with about 5,000 different retailers across the country. Some of the bigger ones tend to be in the e-commerce space, like a Wayfair or Samsung or eBay are some of our partners. And we're a team of about 110 in downtown Toronto. And I'll stop there.
Purpose Financial, you may know us from our mutual fund and ETF business or our ads on Air Canada, but we also run a large small business lending business under the Thinking Capital brand. So we lend up to $500,000 to small business borrowers across the country. We've deployed about $1 billion to Canadian entrepreneurs since 2006.
Excellent, thank you very much. So we'll kick off the discussion to talk about how to attract funding. So what do you need to look like in order to attract funding, and what are some important factors to consider in that vein? And I'll throw it over to Wayne to kick off the discussion.
Sure. So I think one of the main things in our industry is when you're a small company or a startup, you need to attract so much more capital than a small company of the same size in another industry because you have to fund the portfolio. And what that means, I think, is you kind of need to have your act together in a whole bunch of ways much earlier than you otherwise would have. Before I was with PayBright, I was with a private equity firm, and we spent a bunch of time looking at specialty finance companies from an equity standpoint. And there were many, many times where we'd go into a meeting and we would know in about 10 minutes that it was never going to happen because the company didn't have a handle on their data, their loan tape. They didn't have policies written down that were in good shape. They couldn't articulate different aspects of how their book was performing. They didn't have the right metrics. Financial reporting wasn't there. At an early stage, you really have to have all this stuff locked down, because if a lender or an equity provider comes in and feels like they need to teach you this stuff, that's really bad. I would also make a pitch, for example, that it makes sense to get your statements audited almost right from the get-go and just start building that rigorous track record. And if you're at an early stage and you don't have these things in place, you want to find someone who's been there and done it before to help you put those things in place. That's really what separates the good from the great at the early stage.
Tyler, any thoughts on that?
Yeah, I think that's absolutely right. I think, in the fintech side, there's a tendency to focus on the fin, or rather on the tech, not the fin. And in sourcing capital, they care much more about the fin. So as Wayne said, having policies, procedures, and the data, so that when a lender walks in, you're able to provide them with a pretty robust set of procedures that you're following. They care much more about that than they do about your growth trajectory over the next little while. Obviously every lender would like to grow with you and wants to see your growth, but being able to demonstrate robust internal policies and procedures, being able to show that you know how to service loans, you know how to collect on loans, not just how to grow volume, is really critical. And so I think what we've found is having all of that in written documents and in kind of institutionalized form, as opposed to trying to explain it every time on a one-off basis. One, make sure that you're actually adhering to them internally, and that you've got kind of robust policies that are being followed. And two, it simplifies your life when you're trying to deal with a whole bunch of different lenders, which is typically how you source capital, because you're just able to send them a bunch of documents.
Kevin, from the perspective of a lender or funder, any thoughts on those comments?
Yeah, I agree with all of the above. I mean, we're kind of the earlier stage guys. So we talked earlier about barriers to entry and how do we gain financing and so on. And so we work with kind of a lot of earlier stage companies, and kind of to Wayne and Tyler's points of, first and foremost, who are we lending to? Do you understand your processes, procedures? And again, us being, lenders by background, we know what we would like and how we would underwrite deals. And so not necessarily in the same aspects as what an MCA or a small business loan provider might be providing, but who is it that we're lending to? And then kind of for our perspective is the company trading profitably? So we can kind of take a look at those kind of couple of aspects on who are we lending to, is there some profitability? We provide some pretty significant leverage, so we're kind of the earlier stage guys. So it's not always cut and dry, I've got this process nailed down, I've got this procedure nailed down. There should be something in writing, key process controls, management controls, and so on, how you're managing cash and kind of dealing with loans and adjudications. But aside from that, we can be pretty flexible in providing solutions.
Mm-hmm. And Lila, I think perhaps your BMO's a bit more focused on later stage funding. So any comments from that perspective, or anything else that was said?
Sure. So for more established borrowers, there are a couple of things that we look at. And the first and the most important thing, and it wouldn't come as a surprise, is a track record and the ability to demonstrate a track record. Track record of not just financial profitability, but being able to grow and sustain a business at a certain scale. And then the track record of navigating through economic cycles. And then that's becoming harder and harder to test, given that we've been in such a bull market over the last few years. But that to me is probably the most fundamental thing. Secondly, a defined product or a market niche, because as lenders to lenders, we're really relying on your underwriting standards. And for us, we place a strong emphasis on the consistency of that and then the resulting portfolio data. And lastly, I would say stable and tenured management teams who don't just have financial services experience, but really experience with the asset class. Because when the downturn does happen, we are really relying on these management teams to steer the ship and protect our collateral. So that's the perspective from our end. Excellent.
Let's get a little more granular on the actual portfolio mix. How did the considerations change based on the asset class? So if we're talking about consumer loans versus auto loans, consumer finance, how does that inform where you seek sources of capital? And I'll throw that one out to Wayne as well to kick it off.
Yeah, I think our observation has been that different lenders have different preferences in different asset classes and different experience based on what's worked for them in the past or how they structure their deals. I think one of the biggest considerations that would affect more folks in this room is the distinction between prime and non-prime, whether that's consumer or commercial. And there are, frankly, just a bunch of lenders who have trouble getting their head around the non-prime side. And so if you're a non-prime lender, you tend to have a smaller number of options, or at least a different type of potential lenders to your business, or at least that will give you capital at a reasonable scale at a reasonable price. So that's always something to keep in mind. And you have to kind of pound the pavement harder sooner to fund a non-prime book than a prime book. That's just one dimension.
Yeah, I would echo that for sure. The other thing I would add that I think informs what type of lender you talk to is your track record in the asset. And we see this all the time where we're looking to add a product in an adjacent vertical or that even just looks slightly different than what we do today. And quite often that informs who we go to. We've got good relations with some of the banks, but they're often not your first call on a new product. I think a lot of people in this room will understand that the Canadian banks have a great appetite for mortgages, for credit cards, and for auto loans because they've got very well established securitization conduits for those. When it comes to small business, particularly non-prime small business, you sometimes talk to alternative lenders first, and as you build a track record, then you can educate the banks a little bit more. Maybe start with a smaller bank and then move to the BMOs of the world once you've got a track record. Because I think every bank is looking for something different. There is capital out there for all different types of assets and for all different types of track records, I think. It's really just a question of where you start and having realistic expectations. I think if you're a fintech that's built a business case on having a Sched 1 bank lend you at a 90% advance rate from day one, well, your business plan may need a little bit of refinement. But I think if you've got reasonable expectations of equity contributions and of taking time to build a track record, there is capital out there. I think you just need to understand the landscape and understand, to Wayne's point, who's got interest in what.
Our focus is primarily kind of the subprime space, but we're fairly agnostic loan-wise, and again, kind of underwriting to the management team and kind of the acumen of the business. So as long as you're kind of strong in your asset class, and got built your team and your management systems and so on, and reporting around those circles and cycles, we'd be fairly agnostic in industry.
Yeah, I would just add, when we're looking at consumer finance company, the additional diligence that we would do is the framework or the controls that these companies have over the regulatory stuff, right? Like stuff on the consumer protection. And we do place a ton of emphasis on that, as well as looking at the AML, KYC. That would be the key difference when we look at these different asset classes. In terms of sourcing capital from different sources, I personally think it's more driven by scale. A smaller company, let's say plus or minus 50 million of assets, what we are seeing, they are initially relying on alternative lenders, and as the scale happens, then that's where the commercial banks should step in. Or if it's a new product, it does take time, and I'll completely agree, it does take time for the commercial banks to understand, but it helps when there's enough diversification in the portfolio.
Excellent. Now, sort of continuing on this theme of evolution of the life cycle, when a borrower scales, when their book scales, how do the loan terms actually change? Just getting a bit more granular on types of terms of the loans, covenants, etc. Once a borrower scales, how do you see that changing? Maybe I'll ask Lila first on that one.
Sure. So what we've seen as a fast-growing originator or as a startup, companies are really relying on asset-specific financing, or what we call SPV, bankruptcy remote kind of financings. And that doesn't make a ton of sense from a borrower perspective because there's not much equity requirements there. But those do come with additional cost of capital and very restrictive performance covenants because the lenders are really relying on the recourse against those assets. As the company does grow in scale, there's definitely an advantage in looking at more corporate-style financing, more borrowing-based balance sheet financing, because there's enough equity buffer for the lenders to get comfortable. Because at that point in time, we're really relying on, look, we do have performance covenants as the company scales, but we are really relying on the financial wherewithal of the company. And we're also looking at their ability to attract more institutional type of capital or more private equity or public equity type of capital, as well as looking at the business as a going concern. So it's more movement from an pure asset lender to a more corporate facility.
Sure.
Yeah.
Yeah, we're kind of that initial layer. So you're generally the first debt provider. After that layer of equity, business starts building some scale and kind of starting to burn through some of that equity and are hindered by growth. So we're generally in there on the earlier stages, providing higher leverage, less covenants, a little bit more flexibility. And as they start to scale and so on, that's generally where they kind of exit from us. And more introductions to Layla and her group at the bank. And it's like anything. It's kind of that cycle, that life cycle that we play in the more alternative space than the more traditional space.
Any comments from Wayne from a perspective of an originator on the actual loan terms?
Well, I think just generally, if you're scaling, that means you're probably doing reasonably well. You're building the track record. You have larger amounts of assets, and all of that means you can bring more potential lenders to the table as you grow into their size range, as you prove that you maybe know what you're doing. You can tend to get sort of Schedule 1, balance sheets or large institutions involved, and all of that tends to improve most of the terms, particularly the cost of capital. Yes, there may be trade-offs with advance rates and other covenants, but you should be able to, if everything's going well, optimize your sort of capital structure over time based on your scale and your track record. And so we've been able to sort of move down that path in our business over the past few years.
Yeah, and I would even add to what Lila said. I think you can start with asset-specific facilities that have tight performance covenants on the assets, because you've got less equity or less earnings built up in your corporate business. You then move to the corporate facility, as was noted, and I think at some point you can actually look to make a transition back, where you start doing public securitizations and you start building kind of a more robust, diversified financial structure, like what was talked about with Go Easy and some of the on deck US business as well, where you actually eventually pretty much fully off balance sheet into only asset specific facilities, which is sort of the kind of end state for most specialty finance companies, many years down the road once they've scaled.
Excellent. So maybe just getting a little bit more, and I think I heard you actually said KYC, Lila, earlier, but just on due diligence around structuring a specialty finance transaction, what are some thoughts on common pitfalls that you might think about at the outset of a transaction that you think both borrowers and funders should be aware of? Any thoughts from the panel on that question? Sure, Lila.
So I think when we do our due diligence, we really get deep into the portfolio,
Sure.
right? And I think that is essentially key to specialty finance lending, is slicing and dicing the loan data across so many different levels. Because at the end of the day, when we do end up lending, we'll have certain advance rates, which are fairly common across the industry, but we do a lot of work in our stress case scenarios to make sure that the business and our loan is protected in that sense.
Sure.
Yeah.
I think kind of leveraging off of some of Wayne's earlier comments on being organized and having access to information. And again, I mean, we're happy to lend against certain businesses and different asset classes. Kind of make the joke about inventory. We're happy to lend against inventory. You just have to tell us what it is. So again, access to the data and information is really kind of key for us. And again, we kind of come in on the early stages, so we see all kinds of different venues. Things like review engagement or audited financial statements are a huge plus. And we know kind of in smaller, medium-sized businesses that want to avoid the cost for the initial couple of years, but from a lender's perspective, incurring that cost early on just kind of shows that organization and commitment to the business sort of thing. So again, we're probably similar to Lila's, that we're slicing and dicing the loan data and information, and it's access to that information that's the key.
I think maybe on a slightly different but related topic, the one thing that I've seen over the years is people getting tripped up on the relationship of equity and debt, right? The equity side and the portfolio side, and thinking about what has to be in place when. You guys probably see this all the time. And so, what our thought process at PayBright is, if we're going quickly, we need to have the portfolio funding in place now for the volumes we want to have a year from now. And we probably needed to have our equity in good shape like 6 months ago. So we always try to have the equity running like 18 months ahead of where it needs to be, and the portfolio funding a year ahead of where it needs to be. And it's very easy to kind of get the order backwards, and then everything gets stalled. and that's obviously challenging to execute, but it's important not to have a situation where the portfolio funders say, okay, where's the equity, and then the equity guys say, okay, how are you going to fund all this? And so there's kind of a dance that goes on, and I think a lot of small originators over the years have had their growth slowed by trying to figure that out sort of in a timely way.
Yeah, I would absolutely agree. I think that's probably the most common downfall for lenders in this space. Because alternative lenders typically are not regulated by OSFI or someone that forces you to hold regulatory capital, the equity debt balance can be sometimes more subjective. And I think you're prudent to carry as much equity as you can afford, because it allows you to plan for losses that may be higher than you might expect. Whereas in a Sched 1 bank, they're regulated and they're told how much equity they need to hold. We're really not. And so making sure that you've got that dance right, as Wayne said, and that your equity is probably planned in advance of the debt, will allow you to better manage for credit downturns. It'll allow you to better manage for surprises. And to the point, it's generally harder to find that equity when you need it than it will be to find the debt that you need to grow in good times.
Mm-hmm. Mm-hmm. Excellent. And just on, maybe this one's for both Kevin and Lila, on the actual investment guidelines or the investment criteria of that particular portfolio, say you're looking at a MIC, walk us through or talk a little bit about how critically you're looking at that and what the process looks like from a lender perspective when you're looking at the investment guidelines.
Maybe I'll kick it off because I'm sure ours are going to be a little bit lighter than Layla's. Really, we're kind of storybook lenders. It's where could the business be with the right capital. So again, kind of that probably initial debt and early stage, kind of coming to a business after that layer of equity. It really is kind of covenant light and a lot going on. So it's fairly simple for us to provide kind of that initial facility. As long as we've got that management team and the company's achieved profitability, we can provide the capital in a lot of instances and situations.
Sure.
Ours is a bit more structured to that. So we will look at a couple of years of positive operating profitability. We will look at a level of equity base and then underwrite to that equity base. And in terms of the structure, the covenant packages are very standard, but there will be around debt to equity. There will be loan to value that we will look at. So it's those critical things. And again, I think one point is of critical importance is the diversification in the book.
Sure.
I can't stress enough how much do we look at diversification in the book in terms of the underlying loans or the borrowers.
Mm-hmm. Mm-hmm. No, that's helpful. So we had an entire panel earlier this morning on market readiness. So we have a little bit of time left. So maybe just from where we are in the economic cycle, and a lot of people using the R word, recession, where we are, in terms of specialty finance itself, just from the panelists, where do you see the industry going in the medium term in the context of this impending downturn that everybody seems to be talking about? How does that, are there particular asset classes that might be relevant, or from an underwriting perspective, is it getting tighter? So any thoughts on the trend as we move forward in the next part of the cycle? And I'll invite anybody to start. Wayne?
Yeah, I think it's going to be really interesting because this has been such a long expansion, and we have had such a long, benign credit cycle now, and so many specialty finance companies, fintech lenders, et cetera, in Canada, but especially the US and other countries, have all grown up since the last credit cycle, and probably 85% of their employees weren't even in the workforce during the credit crisis. And so it will be really, really interesting to see who's got a bunch of this stuff figured out and are ready for it and who isn't. And so I've always been predicting a big washout, but we'll see. I can just tell you that at PayBright we are, at PayBright we're just watching very closely, sort of week to week, to see what's changing. And what we're absolutely trying not to do is repeat the classic mistake of chasing growth late in the cycle by loosening various credit parameters while convincing ourselves the whole time that it's actually fine. So we're trying not to repeat that cycle, and we're trying to be ready to respond, to going to Jason's comments in the earlier panel, to respond if we need to sort of protect the performance.
Yeah, I would absolutely echo that. I think as much as we'd like to think the growth will sustain forever, I think we all know it won't. The small business space has gotten quite a bit more competitive since Thinking Capital was founded in 2006. Is basically the only one, and so I think we see the market getting competitive. We see people chasing growth, and I think it's important to one, make sure you've got a diversified portfolio, as was said earlier. Two, as we just talked about, make sure you've got that kind of financial dry powder in case you need it, and three, to make sure that you stay disciplined around your credit policies and that you're not chasing growth at the expense of potential long-term profitability.
I think that'll be the key. I think for most in this room, we'll call it maybe a little downturn more than a recession, because we're not really, from our perspective, not expecting a recession. But we see a lot of opportunity opening up. So for a lot of the alternative lenders in the space, I think the opportunities that you will start to see will actually improve. You'll get some of the more traditionals that'll kind of start to move up market a little bit, making more room for better credits and availability in the alternative side. So as long as you've kind of stayed true to your practice and your process, what does your existing portfolio look like today? So it's not necessarily a matter of what's your prospect for new business going to be, because I think it's going to be excellent as long as you stayed true to your process and your procedures, and kind of you got your existing book intact. Then you can kind of be successful through a transition.
Yeah, similar to Kevin's point, at BMO, not just with specialty finance, we are very patient lenders. We are relationship-based lenders, so I think that will follow through to the cycle. But when we are getting into each and every transaction, what we do is we do doomsday scenarios. If, let's say, the borrower defaults, the credit cycle completely turns, we do those scenarios and we see how long will it take us to get out. So we're already doing all the work on that when we get into the transaction. On the other side, we are looking at the portfolio data and the reporting at a very granular level. We've got triggers, we've got covenant structures in place that should give us an early warning and help us modify the structure if needed. So we are getting prepared for it for sure.
Excellent.
And I think for those that are well prepared, there will be huge opportunity. To Kevin's point, I think for those that can handle the downturn well and can maintain the quality of their book through it, there'll be those that won't. And I think that there'll be a lot of business to pick up for those that are well prepared, that'll look a lot better than the business that's probably being chased around the margins today toward the end of the cycle in a more competitive market.
That's great. Thank you very much. Now, we have 1 minute, and I wanted to throw to the audience for one question, but I better not. But thank you very much to our panelists for sharing their insights today. I think that's very helpful, and I'm sure a lot of the audience members got a lot out of that. And we probably scratched the surface on a lot of the things we were talking about, so that probably bodes well for the networking and reception events later on today. And thank you very much.